All right, so this is module 8. This is our last module, just to go over those homework problems. So this first one, we have 210 shares of a stock. They're currently selling at $91, and they just announced a dividend of $2.20 per share. And the ex-dividend date is April 19th. Assuming no taxes, what will the stock be worth on April 19th? So that's the ex-dividend date. So that's the date that the dividend is counted, right? Um, and so the share price will be $2.20 less per share. Um, in this case, you'll see what that stock value, just the new share price times the number of shares outstanding. The decrease, total decrease in the value of the portfolio there is exactly equal to the amount we received as a dividend. So instead of having the value in the share price itself, some of the cash was sent to us, and the share price dropped by that much. It's a similar problem, number of shares, they give us the price, they tell us what the dividend will be, when the date will be, assuming no taxes, what is this impact? So again, we'll just take the share price before the ex-dividend date and then subtract the dividend, and that'll give us our new share price. And then based on that, we can then determine what the new stock value is. And then we have to remember, we would then um, add back the cash. That portfolio value should actually be the same too, as just the shares outstanding times the current or that current share price of 102. Like I said, the share price goes down, but it goes down by exactly how much you receive in cash. So a lot of those problems, they kind of look the same, and that's what they're trying to get you to understand is sort of um, without taxes, with so many things, you're just indifferent um, to the choices available because um, those values, they're equivalent, right? And so the proverbial it's six of one or half dozen of the other, right? It's like you don't care unless there's some special tax treatment or something like that. Okay, so this next one, we're looking at a stock dividend being issued. They tell us what the stock value is, how much there is in surplus over the stock as par value, the retained earnings of the firm, and then we add those together to get the total shareholders' equity. So, on the balance sheet, you have assets on one side, liabilities on the other, which has all the debt, and then this equity piece, right? So assume the company stock is selling at $45 a share. Stock dividend of 12% is declared. So instead of giving cash, they're going to pay out this stock dividend of 12%. And then is that going to be the how does that impact the balance of the equity sheet? Um, so we'll look at that one, and then on part B, instead they do a stock dividend of 17%, right? So part A is at 12%, and part B is at 17%. And again, they're asking, what does that mean for the par value of the common stock? What does that mean for the capital surplus? What does that mean for retained earnings? And then if you notice, the owner's equity is always going to be the same, right? And we'll talk about why that is. So here's the next um, slide to show that. So on the 12% number of shares outstanding, it'll just be 12% more. Right. And so since we have to issue those additional shares, the par value is $1 a share. So that's would go up by that amount. And then it sells at 45. So if $1 is the par value, the 44 remaining dollars per share must be that capital surplus. And then um, the retained earnings also necessarily go down by that total amount because we're using that to fund this dividend payout. Um, but though they go up, dividend or the retained earnings goes down by the same amount, and so the total owner's equity stays the same. So as an owner, if you're indifferent again, right? Unless there's some sort of taxable event that occurs. Part B is the same calculation. It's just using 17%, which again, a dollar a share for par value and 44 additional dollars for capital surplus value on each share. So those values will just go up more, right? Because you have more shares that you're going to put out, which just means that retained earnings drop by more. And again, the total owner equity will be the same throughout. Okay, and this is there's a few different pieces to it, but all that's going on here with the stock split is they are going to take the existing shares and then divide it out so that there are more shares. So in this case, it's a 2-for-1. So for every share of stock you had before, you now have two, right? And so in this case, you know, how many shares are outstanding? It used to be 110,000, now it's 220,000, right? And then the par value was $1 a share, but since we split it, it's 50 cents a share. And then on part B, what if they do a 1-for-5 reverse stock split? So this goes the other way. So instead of you get for every one share, you get 5. For every 5 shares, that counts as 1, right? Um, so you just take the total number of shares and divide it by 5. And so it goes down to 2,200. Instead of it being $1 a share, it's now $5 a share, right? So those numbers, will just multiply or divide based on that stock split. Um, so. And then here's looking at the changes in price. So we have a couple of, or not a couple, four different ways of doing splits or dividends, right? So they tell us the number of shares outstanding. They tell us the current share price. We don't have like taxes or anything. And then, okay, what is the share price under these scenarios? So if it's a 5-for-3, right? And so for every 3 shares, you'll have 5, right? Which is an interesting way of doing it. And then a 10% stock dividend, right? We did a dividend like that before. And then a 37.5% stock dividend. And then a 4-for-7, right? Which is, again, it's kind of unusual. But it's, again, just to get you familiar with the calculations itself, right? And so you can see the calculation there. It's the same formula we used in the last problem. And you can calculate both what the new share price is and then how many shares would be outstanding. Originally, it was 380,000, but it changes depending on the splits or dividends. Okay, this is looking at the dividend impact on the balance sheet, right? So they tell us, okay, here's how much you have in cash, here's what your assets are, and then on the other side, we don't have any debt. We're a completely equity firm, right? So it's all based on shareholder equity, and they just declared they're going to pay a dividend of $1.50 a share, right? Goes ex-dividend tomorrow, and we have no taxes. Again, taxes themselves cause interesting behavior, right? So when we're absent that, this is really what we're focused on. So what does the stock sell at today? Well, you see the total value of the equity is 624,960, and there's 28,000 shares outstanding. So you just divide total equity by total shares of stock, and that tells you the equity per share, and that's 2232, right? What does it sell at tomorrow? Well, if I want to pay $1.50 as a dividend, then the share price will go down by $1.50, right? How will the balance sheet look after after it's paid? Well, obviously, I'm paying out this money, right? So if I'm paying out this money, it's $1.50 times 28,000 shares, that's $42,000. So cash will go down by 42,000. And for the balance sheet to work out, equity also goes down by 42,000, right? If it goes down on the left, it has to go down on the right because they both have to balance. And so we pay out the cash and then the value of the shareholder. The shareholders' equity within the firm is lower because they receive that cash from the firm, right? So that's what's going on with that. This one is a little bit different than paying a dividend. This is doing a stock buyback, right? And so what happens is the company decides I could pay this money out as a dividend, but instead I'm going to take that money and just go buy shares of stock in the market. Um, as a shareholder, again, I know I say this a lot, but you're indifferent, right? You just don't care uh, which way they do it. If they go in the market and they start buying shares, well, the share price will go up. And so you get the value that way. If you don't want to be in the company and you want cash, you can just be one of the people that sells your shares, right? And so you can get the cash. So no matter what you want to do, you're able to do that, right? You have all that flexibility. So as long as again, no taxes or anything like that, you don't really care either way, right? Um, and so that's what they're doing in this case is they're going to go and repurchase these shares. What impact does that have on the equity of the firm? How many shares will be outstanding after this repurchase? And then what will the share price be after the repurchase, right? So understand just like when we paid the dividend, if we do a stock repurchase, it does the same thing where we reduce that shareholder equity, just like we would reduce cash, right? Because we would go out into the market and spend cash. It's also going to reduce equity by the amount that we're purchasing, right? That's what's going on there. As far as the number of shares outstanding for that, then um, we're going to calculate what the current price would be. We know there's 27,000 shares. We know shareholder equity. So we calculate what that share price is. And then to get the number of shares that we would repurchase, it would be that total amount, 37,800 divided by that share price. And that's the number of shares that we have to repurchase, which means we've reduced the 27,000 shares by that new amount, right? And then what is the new stock price, right? Well, if you go out and look at the share price, right, it goes down by exactly what we paid out, right? And then we're dividing it by that new smaller amount of shares. It's going to end up being the same as the share price was before the repurchase occurred, right? And so again, it's effectively the same as a cash dividend, right? So, you could get the money either way, and so you're unaffected. Again, this goes back into that whole where you're going to be indifferent to what they're doing because you could synthetically do it yourself. Okay, here's another one with stock dividends. I won't bore you walking through all of it. Feel free to pause to sort of look through the problem. Um, it's a 10% share dividend instead, right? So it's the same problem, just doing it with a share dividend instead of a cash dividend or instead of a stock repurchase. So they look very similar. And again, that's why we're indifferent, when we're doing this. Okay. Here's a company that's going to declare a 7% stock dividend. Stock is currently at $65 a share, and then you see the shareholder equity sheet there with the par value at $1, the additional surplus, any retained earnings, and then total equity. And so it's like, how do these change based on this dividend? So the number of shares outstanding is going to change by 7%, right? It's going to increase by 7%. And then the capital surplus, right? The capital paid in excess of that par value, right? And so instead of $1 per share, it'll be that 64 remaining dollars, right? Because it's 65 total in the market, right? And then that would give us what the capital surplus is on these new shares that we've sent out. And then the new capital surplus will be that additional capital surplus from the shares plus the old capital surplus. So um, as we're increasing, um, yeah, so yeah, that's how the numbers change, right? So you notice retained earnings has to go down by the increase in both the common stock because the number of shares goes up, right? And it's $1 a share, so that has to go up, and the capital surplus goes up, and all of that comes out of retained earnings because shareholder equity has to stay the same, right? Because we didn't do anything but sort of reorganize these shares by paying this dividend out. Okay, and then this is doing a stock split. So they decided they're going to do a 2-for-1 stock split. They do a 34-cent per share cash dividend on this new uh, number of shares, right? Because it's 2-for-1. And it represents an increase of 10% over last year's stock. Okay. So what's the new par value, right? And then what was last year's dividend per share? So if it's currently, it's a dollar value. It says their common stock, $1 par value. If they're doing a 2-for-1, we know that that splits that by two. So instead of it being a dollar, it's now 50 cents. And then the total dividends paid is 34 cents times they did have 500,000 shares, right? If it at a dollar par value. Um, Now it would be a million shares because that 2-for-1 stock split, and so the total dividends ends up being 340,000. If it increased by 10%, you'll just subtract off the 10% or divide by 1.1, to take off that 10%. And then you would just divide that by the old shares outstanding, and that tells you what the dividends per share were before. Okay. On this one, you see it's part one. Part two will be answering the B part. And that one's a bit of a longer answer, but we have an all equity firm. They expect to last for 2 more years, and then we're going to dissolve. So this is going to be our last 2 years to generate money. They're going to generate cash flows of 760,000 next year, 1.1 million in 2 years, and that includes all the proceeds from liquidation, so selling equipment, all of that type of stuff. There's 33,000 shares of stock outstanding, and the shareholders require a return of 10%. So, what's the share price of the stock? Well, we know how much people are going to be getting, right, in year one and in year two. We know how many shares there are. And so we can calculate what the cash flows for year one and year two per share are. And then we can calculate the present value of those future cash flows. And then that would be the value today, right? So um, same types of problems that we did earlier on, right, with the time value of money, right? So now the board is dissatisfied with this dividend policy, and they want to pay a dividend of 840,000 next year, right, instead of the 760. To raise the cash necessary for the increased dividend, they will sell new shares of stock. So how many shares do they have to sell to raise the additional money, right? To go from 760 to 840, right? And then what is the new price per share of the existing shares of stock? So I'm gonna go to the next slide. And feel free to pause it and take your time to sort of reading through that. But all we're gonna do is take we need an additional $80,000. How many shares do we have to sell to get 80,000? Well, given the current share price, it's a little over 1,500 shares. And then since we're changing the way the money comes back, you get 80,000 in year one, right? And so at year two, you got to get your 10% dividend. So we're going to pay 88,000, right? Um, and so the dividends that we're paying in year two is going to be that initial amount we were going to pay minus the 88,000 that we have to pay to these new shareholders, right? That gave us the originally 80,000. And so we'll get this different amount. So the dividend per share is going to be a little bit different because instead of getting 760 the first year, we get 840. Instead of getting 1.19 million, we're getting 1.102, right? But again, you just calculate the present value and it ends up being the same, right? And the big takeaway is since we're paying the same 10% for these new shareholders as we did the old shareholders, it basically ends up being if we were to balance the payments out so that you receive more in year one, you're going to receive less in year two. Again, you're indifferent, because you're going to receive the money. And this is assuming no sort of market frictions. In the real world, you would care. If you get the money faster than you expect it, then now you've got this reinvestment risk where hopefully you can find another good investment because sitting on cash doesn't do you any good. You want to have it returning an interest, right? And if you get it back too late, that's not good either, right? These delayed payments. Because then you might be locked into like a lower interest rate and you would prefer to end this so you can get something better, and you're locked out, or like locked in actually, I guess, in this low rate. So but without anything, yeah, anything like that going on, you're going to be indifferent. Okay. Here's another stock repurchase type question. Um, but this is just basically working through some of our formulas that we've done before, and then figuring out in this particular case what would the pre-tax return be, for us to but based on like the growth rate, the dividends, all those things. So but yeah, feel free to pause that and read through it as necessary. But yeah, we just have a dividend yield of 4%, and then you're going to calculate what the growth rate of the firm is, and then by adding those together, you can come up with the pre-tax return. Okay, this is an initial public offering or an IPO. So you have two firms. They both announced an IPO at 49 a share. One of them is undervalued by 13.50, and the other is overvalued by 6.50, but you don't know which is which. And so you plan to buy 1,450 shares of each. If an issue is underpriced, it'll be rationed, and only half your order will be filled. So you don't know which one's which, but you do know you're only going to get half of it if it is the underpriced one. Okay. Assuming you could get 14 of each, what would your profit be? What profit would you actually expect? And then what principal have you illustrated, right? And so if you get 1,400 shares of each, then the profit would be the 10,150, right? So it's just, the undervalued is profit for you, the overvalued is a loss, right? And you just net that out. But you're only going to get half the shares if it's oversubscribed. It means everybody wants it, right? And so because of that, your expected profit's only half as much on the upside, but you bear the full losses on the downside, right? And so your actual expected profit is much lower than half, right? And so they call this the winner's curse, right? Congratulations, you won when everybody else did. It didn't help you much, and you bear all of your losses, right? Okay, and then this gets into like the underwriters and what they're doing, and so need to raise 66.2 million. They're going to sell new shares. The offer price is going to be $62 per share, but we have to pay this 8% spread to the underwriters, and the underwriters, that's the investment bank that's going out finding the people to buy it, coordinating all of that sales piece, right? What's known as a sales syndicate. They'll get together and do that. And they also do all of the underwriting, the due diligence to make sure we have all of our paperwork filed appropriately with the state and federal regulators. And so, they have to generate their profits for that. So they need 8%. And so basically we're just going to say, okay, if we have to take the 8% haircut, what does the 62.2 million look like? Well, including that, we actually need closer to 72 million. Dividing that by the 62 shares, that tells us how many shares we have to offer. And when I say have to offer, that's what it says in the answer, but it's actually how many need to be sold. So it's not just offer that, but they need to all be sold for us to both cover our underwriters and raise all of the money we need. Here's another one about doing an issue of a security under a firm commitment agreement. And so when I mentioned that sales syndicate, they can do best efforts, which is, again, we'll just do our best. Firm commitment is like fundraisers at school when they give you like a box of candy. If you didn't sell it, that's okay. It just meant you bought it, right? And so that's kind of what the firm commitment is. If they can't sell it within the underwriting syndicate, then the members themselves will buy it so that we know that all gets placed. And so that's when I was talking about that offer before, right? They all have to be placed. But the company is going to receive 33.60 for each of the 4.26 million shares. The initial price was 36 per share. It rose to 44.20 in the first few minutes. The company paid 9.21 in legal and other direct costs, and then 2.82 in indirect costs. And then what is the flotation cost as a percentage of funds raised, right? And so when you're saying how much money did we raise, we got 33.60 a share. We got the total number of shares. We paid out our legal and direct, and then we paid out our indirect costs. So once you net all that, that gives us our total amount that we received from the stock offering, right? So as far as what are our direct costs, well, they offered it at $36 a share. We received 33.60 a share. So that difference, the underwriter gets to keep, right? They pay us 33.60 and they're selling it for 36, right? So you take that difference, multiply that by the total number of shares outstanding, and that's how much they receive off of that difference in the spread, right? They also are going to receive that legal cost up front because we had to pay for the attorneys to do all their work, and all that type of thing. So both of those combined will tell us what the direct costs were of what we paid, right? So some of it we paid, in that direct fee, and some of it was that float and the difference in what we received and what the initial shareholder paid. Okay. Now, as far as the indirect costs, they did tell us that we have this $282 indirect cost, right? As far as what are the other indirect costs, it's that IPO increase, right? And this is very common right after that initial issue. The value of the stock will go up, right? In this case, it went from 36 to 44.20, right? And so all of that additional money, which is entirely the shareholders. That's why shareholders like to be in these IPOs, right? So they bought it at 36, and then in that first few minutes, they're watching that stock price shoot up to 44.20, right? But that difference is considered an indirect cost. So you add that to the 282, and that gives you the total indirect cost. direct and indirect cost gives you the total cost, right? Total cost divided by the total amount raised will then tell you what percentage was the flotation, which in this case, it's that 32%, which is pretty high, right? I mean, but if you think about the fact that they received 33.60 and within a few minutes their stock price was 44, that's you know, a third increase, right? So, um, yeah, there's a lot of money left on the table, there. Here's another, flotation type problem. They need to raise this particular amount. They are going to do a general cash offering to raise the funds. The offer price is 29 a share. The underwriters are going to charge 8.5%. The filing fee and the administrative stuff is 1.5 million. How many shares need to be sold? And so, we have these expenses plus the total amount that we want to raise, right? That gives us the total proceeds that we need after the 8.5% haircut. And so the total proceeds to include covering the underwriters is 57.6 million. Divide that by the $29 offer price, and that gives us the number of shares, which is just under 2 million in this case. Okay, and then this is a dividend problem. They declare a dividend of 6.20 a share. Capital gains are not taxed, but dividends are at 30%. IRS say the taxes can be withheld at the time the dividend is paid. The stock sells at 113 per share, and the stock is about to go ex-dividend. What will be the ex-dividend price, right? So if we are paying 6.20 in dividends, right? After you pay the taxes on it, you would only receive 434, right? But since we can withhold it right there at the company, right? Um, then it would drop by that after tax dividend amount, right? In the real world, actually, it doesn't get withheld that way. You have to account for it on your own individual taxes. Okay, and this one, there's going to be four parts to this problem, but we're looking at dividend policy. And so one of the models that they use in determining like this ex-dividend price, once we start having taxes, you see the P0 minus PX all over D is equal 1 minus T sub P divided by 1 minus P T sub C, right? Where the P is the price, right? Where P0 is before X dividend, and then PX is the X dividend price. The D is the dividend, and then T sub P is the personal tax rate. And then I said T sub C for capital gains, but it's T sub G. But that's again, it's for the tax on capital gains, because often your personal tax rate and your marginal tax rate for capital gains will be different, right? Because capital gains are taxed differently. Um, if there's no taxes, right? How much does the share price fall when it goes to X? Well, if you look at that equation, if you put in zeros for the T sub P and T sub G, um, then D is equal to P sub 0 minus P sub X, right? Um, and then on part B, if the personal income tax is 14% and there's no capital gain tax, how much will the share price fall, right? And so you just put in the appropriate, 0.14 for T sub P, right, in the numerator, and then 0 for T sub G in the denominator. And then we would just solve for how much the share price, will fall uh, based on the taxes, right? So in this case, it's not equal to the dividend; it's only 0.86 of the dividend, right? And so again, just put that equation at the top so you can see as a reminder, right? If the personal income tax is 15% and capital gains is 27%, how much did the share price fall? And it actually is more than the dividend. It's because the way capital gains are treated at this much higher tax rate, right? And so that dividend is not viewed the same way. And then can suppose that the only owners of stock are corporations, and corporations get at least 50% exemption from taxation on dividend income they receive, but do not get that on capital gains, right? And so assume they're both 25%, but remember on that, what will be effectively the personal taxes, but it's the corporate taxes. As long as it's not capital gains, they're immune to 50% of the taxation, right? And so you just put that additional 0.5 in the calculation there. And again, calculate um, how much it goes up. And then it's again more than the value of the dividend itself. All right. So it's been a pleasure. This was the last module, the eighth module. So if you do have any questions or concerns, please do not hesitate to reach out to me. Thank you.